Welcome to a video that I call the InterMarket Analysis video update. The goal of this video is to look outside of the S&P 500 at other stock indexes, as well as outside of the stock market itself, to get some ideas of interactions taking place that can give us some insight as to what is happening in the S&P 500. And this is being prepared for March 6th, 2023. Before I get started, there is some noise behind me, so if you hear a lot of different things going on, I can't control that, and I don't know when it's going to happen, so I just have to power through this. The first thing that we look at is a thing called S&P 500 valuation. How is the S&P valued? Is it expensive? Is it inexpensive? Is it just about right? Well, by looking at this chart, we can look at the trailing 12 months of earnings. Those are the series of dashed lines on this chart. When we have a price-to-earnings ratio of 20 or above, the market is considered to be expensive, and that is the red dashed line. And that's currently where we're at right now. If we were to drop in price down to a PE ratio of 15, the market would be considered fairly priced. And if we dropped all the way down to the green dashed line, that would be a PE ratio of 10, and the market would be considered inexpensive. Down on the bottom of this chart is the spread between the current price of the S&P and the PE ratio of 20, and we're above this zero line, meaning that the S&P is expensive on a trailing 12-month basis. This next chart is just a historical chart going back to 1980 and different events that have happened, and then where we're at right now as far as the current valuation of the market. Now, the market doesn't just use trailing 12 months. In fact, the stock market uses forward-looking PE ratios based on earnings projections and forecasts. And each day, this forward PE ratio is recalculated. Well, as of March 3rd, the current PE ratio is at 17.9. So we're not fairly priced. We're above the 15 level, but we're not all the way up to the 20 level. Another area that we look at is growth versus value. When growth is really doing well, that's when you buy low and sell high with the idea that growth stocks grow. We look at a growth index and see on this chart that the growth index is still in a downtrend and has been in a downtrend since the early part of 2022. We also compare that with a value index, where value held up a lot better as the market was having more difficulty, and it is still in an overall uptrend. Then we look at the growth to value ratio, showing how growth is underperformed on the top. On the bottom, we look at the value to growth ratio to show how value has been outperforming, and value still has continued to outperform growth. Another area that we look at is a growth index versus a value index, comparing the two, showing how growth has been underperforming value. This is an inverse of that same chart, showing how value has outperformed growth. Another area that we look at are some ETFs, showing again how growth has been underperforming value. This is an inverse of that same chart, showing how value has been outperforming growth. Then the last chart just looks at growth versus value with indexes, showing how growth, even though it's improving slightly, has still continued in an overall downtrend. Some other markets that we look at, the 30 biggest software companies, they're getting to the point where it's giving us a golden cross. This is a huge area in tech. And it doesn't mean that tech necessarily has to be the number one sector. It would be nice if tech did participate in an upward movement. That would give some real power to the stock market. So the fact that this is giving us a golden cross and showing some improvement is positive. Another thing we keep an eye on is the CRB index on the top. That's a monthly chart where it's still in an overall uptrend, but has been showing some weakness. Down on the bottom are inflation areas of the CRB index compared with deflationary parts of the CRB index, and overall, it doesn't show that inflation has really been picking up lately. Another area to look at inflation is the Baltic Dry Index. How much does it cost to ship products from one point to another? And it has been bouncing back up lately. The CRB index, another measure of inflation for us, where it had been in a strong uptrend, saw a recent death cross and has been chopping sideways as the CRB has continued in a downtrend. Corn, after spiking up and coming back down, is just about in the midpoint. Aluminum also spiked up and has been coming back down, just about getting ready to see a golden cross. Heating oil spiking up has been coming back down. Gas spiking up, coming back down, starting to go back up at 275. Natural gas, after hitting 10, fell all the way down to just over 2 and currently is at 301. Oil continues to be about at the 80 level. We're just underneath that now at 79.68. Diesel prices, after really spiking up, they have also continued to come down. And wheat spiked up and has been declining. Fertilizer spiking up and has been declining. Lumber, which spent 2022 in a pretty sizable decline, started to bounce back up at the beginning of 2023, but has since started to fall back. The dollar, which was really strong in 2022, started to see some weakness at the end of 2022, enough to give us a death cross, but lately it has been showing a rebound. The euro against the dollar shows where the euro has lately been coming down as the dollar's been going back up. We also throw the Japanese yen in here. It also had been going up, but we're seeing some weakness in the yen compared to the dollar. Then the middle area is the euro to the dollar, and the bottom is the US dollar index. The British pound to the dollar, after giving us a recent golden cross, has been showing some weakness. And here's the Japanese yen, recent golden cross, but weakness as well. Copper, giving us a recent golden cross right at the beginning of 2023, and it's been holding up fairly well. This is a barometer of the market. If copper's going up, economically things will be better into the future, and the inverse of that is true. What is becoming a bit of a concern that as copper continues to go up, that may put some inflationary pressures on the economy. Copper to gold ratio, still in an overall uptrend with copper outperforming, but it has been falling back lately. And here's a longer term look at that same chart. I also plot a 2-year yield, which has been spiking up as the copper to gold ratio has also been going up. And there's still quite a wide spread between the 2-year yield and the copper to gold ratio, where they tend to go in the same direction and they tend to not get very far apart from each other. But that's not what we're seeing right now. Gold, after giving us a recent golden cross, has been showing some weakness, but in the past week or so has been bouncing up slightly. And the same thing with silver. Recent golden cross, weakness, coming back above its 200-day moving average. Looking at some other indexes, here's the CRB index against the S&P 500, where the CRB had been really outperforming the S&P, but lately we've seen a death cross as the S&P is starting to outperform. And here's an inverse of that same chart, showing some strength in the S&P 500. The NASDAQ 100 to the S&P 500 shows how the NASDAQ 100 had been really underperforming, but we're seeing some real strength here. It's been bouncing back up to its 50-day moving average. We're not there yet with a golden cross, but things do look like they are improving. Looking at the S&P 500 against some other stocks, here are mega cap growth stocks. This is the Apple, the Google, the Microsoft. They're showing some improvement, but not enough yet to give us a golden cross. Here's the mega cap index that we just looked at compared to the equal weight ratio. That's a different index that takes all of the stocks and treats them the same, unlike the S&P 500, which is a weighted index, so the bigger companies have more of an impact. Showing some improvement here, but still in an overall downtrend. And the S&P 100 against the S&P 500 shows how the S&P 100 is showing some improvement, but is still in a downtrend. Small caps against the S&P 500. Follow this one really closely. When small caps start to outperform the S&P, that can give some real support to the S&P 500. Low volatility stocks, these are what folks like to get into when the market's having trouble. We've been chopping pretty much sideways, but we're still in an overall uptrend, even though we're seeing some recent weakness. Here's the ratio between low volatility and the S&P 500. The low volatility stocks had been in an uptrend, but they're just getting ready to give us a death cross in this ratio. The Dow Jones Composite Average is still looking pretty positive overall. This takes the Dow, the transports, and the utilities together. So this is a pretty broad market measurement. Here's Dow theory. On the top is the Dow, the transports, which are outperforming the Dow right now, and utilities, which are actually underperforming the Dow. Another way to use Dow theory is to use the S&P on the top, where it started to break out, but then we're seeing a real pullback. But so far, it's been holding on to this upward trend line. The NASDAQ on the bottom is a broader measure, where we're seeing basically a positive divergence here, where the NASDAQ was making a new low, but the S&P 500 was making a higher low. The NASDAQ ended up coming back and rebounding from that. It's been falling back, but lately has been showing some strength. The FANG stocks just gave us a recent golden cross, so that is positive for tech. ARK is still in an overall downtrend. It's going to take a few weeks of some decent price action to have a golden cross. High beta stocks, which outperform the market not only on the way up, but they also outperform on the way down, meaning that they go down faster. When this is really going up, that means that we're in a risk-on position. Folks are getting out of safer investments and wanting to get into the stock market. When there's a red line on top here and we're going down, that's more risk-off. They're getting out of the stock market and putting their money into more safer investments. At the beginning of 2023, we saw a real nice run-up with the high beta stocks against the equal weight ratio. Lately, we've been seeing a pullback as the market's been experiencing some weakness, but it's starting to bounce back up, so we're wanting to see if that strength can continue. This chart looks at the S&P 500 against international stocks, where the S&P is still above an advancing red line, so that's positive. We're watching the PPO on the bottom to see if that can turn up, and so far it has not done that. So we're positive up here, but we're still negative on the bottom. Looking at bonds to stocks, here's a look at the total bond ETF. After giving us a recent golden cross, has been showing some weakness, but in the latter part of last week, bonds have been going up in price and down in yield. Here's the World Bond Index after giving us a recent golden cross. Now, some weakness. We're trying to see if this index can start to go higher. Stocks continue to outperform bonds on this monthly chart. And this also shows how bonds are underperforming stocks on a shorter maturity chart. Here's the high yield corporate bond ETF after giving us a recent golden cross, has been showing some weakness. We're wanting to see, can this begin to bounce back up? And the same thing with this chart, which shows the investment grade corporate bonds. Recent golden cross, some weakness. Can this start to recover? Looking at the stock to bond correlation, where stocks are having a pretty strong tendency to go in the same direction. So if bond prices are up, chances are the stock market is also up. Another thing we look at are corporate bonds, where we're just seeing a recent golden cross, but then we saw some weakness here. Can we get back above this 200-day moving average and eventually above the 50-period moving average? 10-year Treasury yield, after going up over 4%, settled down at 3.964%. Here's another look at the yield, showing how it went back above 4%, only to close down below it on Friday. Here's another look at the yield, where it really spiked up and went well over 4% and then has since fallen back. Here's the 30-year yield, which currently is at 3.9%. And here's the S&P 500 to the 10-year yield, just showing how rates have been going up more than stocks. Junk bonds, this tends to follow the overall stock market. These are high-yield bonds where folks want to get into this to get a better return, but they're also experiencing more risk. After seeing a recent golden cross, we are seeing some weakness, but over the last few days, we saw a pretty nice little bounce. This compares the junk bond ETF with government bond ETFs, showing how junk bonds have really been outperforming. This is an ETF of the price of the 7 to 10 year bonds, showing how price has been coming down. We may have hit some kind of a bottom, and now we're starting to go back up. Looking at the top, we have an RSI that's turning back up, but still below 50. And then on the bottom, we have a declining MACD. We have a number of yield curves that remain inverted. The 10 to the 2, the 10 to the 3 month, these are the ones that the market tends to pay attention to the most. We also have the 30 to the 5 year, the 10 to the 5 are also inverted. Here's a daily chart of the yields where they had been really going back up. And then in Thursday and Friday session, we saw yields going down. And here's a weekly chart looking internationally at how the US, UK, and German rates have been going back up. Japan still has pretty low rates, but they have their own scenario that they're trying to work through, and I'm keeping a close eye on that. Looking at the S&P to different sectors, here's the S&P to utilities. When the S&P outperforms utilities, that tends to give some real support to the S&P. We've been chopping around a lot in the latter part of 2022 and into early 2023. If this can really break out and continue to go up, that will give some really good support to the S&P. If we hit a top and start to come back down, that usually marks a top in the S&P. Staples, the things that you have to have no matter what's going on in the economy, still in an overall uptrend, but falling back after giving us a recent golden cross. Here's the energy sector, which continues to outperform the S&P 500. And the tech sector, giving us a golden cross. That's a change. Semiconductors also gave us a recent golden cross, and it's a huge part of the tech sector. Tech to the S&P is really starting to outperform, but in this ratio, we're not quite at a golden cross. Here's looking at the S&P 500 against discretionary, the things that make life fun. This measures S&P against discretionary, how the S&P has been outperforming. Then on the bottom, it shows how discretionary has been underperforming, but we're seeing a recent golden cross in this ratio. The energy sector still continues to be strong overall when compared to the S&P. Materials also in an overall uptrend. Financials also in an uptrend. Real estate in an overall downtrend. Utilities, after giving us a golden cross, quickly lost that to a death cross. And now we're in an overall downtrend. Healthcare, still in an overall uptrend, but could be getting ready to give us a death cross. And then here's the healthcare to SPY ratio. Really have been going up strong. Now some weakness, and we might be getting ready to see a death cross. Communications, still in an overall downtrend, but showing some improvement. Staples, still in an uptrend, but could be getting ready to show us some more weakness. And industrials, still in an overall uptrend. And the NASDAQ 100 to the S&P shows how the NASDAQ has really underperformed the S&P 500, but it's trying to bounce back up. So there is some improvement in this chart. And the NASDAQ 100 continues to outperform the NASDAQ itself. And the NASDAQ 100 are the 100 biggest stocks in the NASDAQ, where the NASDAQ also has just a huge amount of small companies. Some other areas to look at, growth versus bonds. They both really got hit hard in 2022. We're starting to see growth outperforming bonds. And the 10-year yield rise has been a lot greater than the tech sector rise. So the rise in yields has been outperforming tech. And this shows how the tech sector has been underperforming the rise in interest rates. Discretionary has really been underperforming staples, where staples have been outperforming discretionary. Energy has really continued to outperform technology. Gold continues to outperform the S&P 500 a little bit. It's in an overall uptrend, but gold is so volatile, it's really hard to get a good handle on this ratio. Gold to the dollar, as the dollar was going down, gold was going up. As the dollar has been rebounding, gold has been coming back down, but gold rebounded a little bit last week. High leverage loans, if we were getting ready to fall off a cliff, you would not expect this to be breaking out, which is exactly what it's doing, and an overall uptrend. We look at this chart the same way we do the VIX. When it's really going up, that means there's a lot of fear. When there's a blue line and it's going down, that means fear is decreasing. We had been really decreasing so far in 2023, but then as the market hit some difficult times, fear has been going back up. Well, with some strength that we saw in the previous week, this is starting to come back down. Looking at our InterMarket Analysis chart, still shows that oil's in the lead, followed by the dollar. Gold, going back to the beginning of 22, has finally crossed over positive, where the S&P and bonds continue to be negative, even though they're improving slightly. Looking at some different indexes, this is the Amex, NASDAQ, and NYSE. When we're above this zero line, that's more positive. When we're below, that's negative. And this measures the 5-period moving average of the highs minus the lows. We just had dropped below the zero line only to bounce back up later in the week. Small cap index, recent golden cross, showing some strength, falling back. Now we were able to get right back up to this pivot point. And here's another small cap index, the Russell 2000. After breaking through support, we were able to regain that support with the Russell 2000. We're seeing some improvement on the top with the RSI going back above 50. The MACD is still declining, but trying to turn up. Looking at the small caps to S&P 500 ratio, that's the red line here. When this is going up, that can give some good support to the blue line, which is the S&P 500. Here's the Elder Impulse system for the small caps. They've switched back to positive. Mid caps, recent golden cross, went up, hit resistance, falling back. Now we're able to get back above the pivot point. Here's the Elder Impulse system for the mid caps, where we have now switched back to positive. The Dow has been chopping sideways for quite a while now after giving us a golden cross. Came almost down to its 200-day moving average, but was able to bounce back above that. We're still below the 50-period moving average, but we did close above this pivot level. With the diamonds turning back to positive. The NASDAQ not giving us a golden cross yet, but showing some improvement and right at the current pivot level. Here's a Fibonacci chart of the NASDAQ where we never got up to the 38.2% retracement before falling back. we look at the NASDAQ 100 for that. Here is the NASDAQ 100 where it came up, hit some resistance, pulled back. Now we're coming right back up to this pivot level. And here's the Elder Impulse System for the Qs, which is turned back to positive. Here is the Fibonacci chart. From the all-time high to the October low, we came right up to this 38.2% retracement. We've been falling back. Now we're starting to bounce back up. We'll see if we can give that another try at some point in the future. NYSE Composite, recent golden cross, breaking out, showing some weakness, but could be beginning to recuperate. The Wilshire 5000, recent golden cross, recent weakness, but showing some recent strength. All stocks, after giving us a golden cross, breaking out, showing some weakness, looks like it could be getting ready to go higher. Emerging markets, recent golden cross, could be getting ready to go back up. International stocks, China, emerging markets, Europe, and Japan continue to be in downtrends. And then at the bottom is the S&P 500, which is also in an overall downtrend. Bitcoin is still in an overall downtrend, but could be getting ready for a golden cross here. It was up into the 24 range, and then between Thursday and Friday, just poof, gave up $1,000. So it is showing some weakness now, but it's been floundering around so much in a downtrend, this might attract some buyers if we see a golden cross. Looking at some correlations, the S&P to the dollar still having a pretty strong tendency to go in opposite directions. S&P to oil, pretty much a neutral relationship now. S&P to the 10-year yield, still going in opposite directions. And the tech sector, the 10-year yield, still going relatively strong in opposite directions. The S&P to the 2-year yield, opposite direction. So if you think about that, that makes sense. If stock prices are going up and interest rates are going down, that means that this negative correlation is still intact. Looking at the home builders, we're wanting to keep an eye on this, where we've been seeing some weakness with the S&P, although we bounced on Thursday and Friday this past week. The home builders ETF did bounce, but not quite as much. So our ratio is starting to go down ever so slightly, and the relationship between the two is starting to wear off a little bit. Not a concern right now, but just something that we want to keep an eye on. If the home builders really start to diverge from what the S&P is doing, that could be quite negative for the S&P 500. Some long-term studies, the NYSE Composite on a monthly chart with the Copic curve trying to turn back over positive. And if the NYSE is doing well, chances are the S&P 500 is doing well also. Here's also another look at the NYSE Composite with the NYSE record high percent index. After bottoming, it continues to go back up. And here's the PPO with the S&P 500 very long-term monthly chart starting to go higher. So that's showing some improvement. And the ratio between the S&P 500 and the CRB index shows how the S&P 500 had really been underperforming, and now it's turning back up and starting to outperform the CRB index. This is the S&P 500 against global indexes, where we continue to be above this red line, even though we've shown some weakness here. But the KST is not showing any strength now, so we're seeing a mix in this chart. The monthly S&P 500 on the top with the CRB to US bond ratio on the bottom, where the CRB had been really outperforming and now that's starting to underperform. That means that bonds are doing better, and if bonds are doing better, that could give some support to the S&P 500. Here is bonds, the 30-year price chart, where it really suffered a lot in 2022, trying to make a comeback right now, but not really changing the trend. But if you look at the bottom, the 30-year bond to the CRB ratio shows that bonds are starting to outperform the CRB index. Here's the CRB index on a monthly basis, where it was really strong, but since has been pulling back. When you look at the ratio between the CRB index and bonds, that just shows that the CRB is starting to underperform as bonds are outperforming. Here's another price chart of bonds on the top, and the US bond to the CRB ratio showing how bonds are starting to turn up. So this is just an inverse of the chart that we just looked at. And then here's a ratio of bonds to the CRB on a weekly chart. The short term is still in an overall downtrend, but the intermediate term has the KST in an overall uptrend. So this could give some support to bonds. An update of our possible positive scenarios. The Qs to the S&P 500 are still outperforming and above this moving average. It's showing a little bit of a slowdown with discretionary to the S&P 500, we dropped below the moving average, but we could be getting ready to go back above. And then large cap growth to large cap value continue to outperform. Some other growth value ratios, large caps are outperforming, mid caps holding up well, and small caps, which were showing some weakness, are starting to make a comeback. This could be positive for the overall market. Looking at the S&P 500, those stocks that are above their 50-period moving average were just about in the midpoint. And with the mid caps also showing a little bit of improvement the past few days, and the small caps also showing a little bit of improvement. This is the 50-period exponential moving average of the new highs minus the lows. We're still positive. We're above zero, but you see how this red line is starting to turn back down. So we want to keep an eye on this indicator. And here's that same indicator. That's the black EKG looking line. What we follow more closely is the red moving average line. It's still above zero, but if this starts to drop below zero, we will make note of that. We're also watching the 2-year Treasury yield, which is now setting a new high. So once it gets done going higher and coming back down, we'll see if it provides a spike that can give some support to the S&P 500. And then the Staples to S&P 500 ratio, after giving us a spike, has been falling back, tried to bounce up as the market was showing some weakness, but since has been resuming its overall downtrend. So the things that are positive, we have the value indexes as well as the ETFs, the euro, the Japanese yen, and the British pound, copper, gold, and silver, the S&P low volatility ETFs, the Dow Jones Composite Average, bonds looking at ETFs, high yield bonds and investment grade bonds, as well as world bonds and corporate bonds, junk bonds, staples. We have a new addition. Semiconductors are still positive, and now the tech sector has given us a recent golden cross. So that's one change. High leverage loans continue to be positive, small caps, mid caps, and the Dow. And then the NYSE composite as well as the Wilshire, all stocks, and then emerging markets continue to be positive, even though they've been showing some recent weakness. On the negative side, we have growth still in an overall downtrend. The big software companies, the CRB index, the dollar, mega cap stocks, FANG, ARK, NASDAQ, and NASDAQ 100, as well as Bitcoin. So thank you. I hope you found this useful. I will be preparing the deep dive video, which is where I go through a lot of the charts that I didn't discuss in any of the videos this past week, or at least didn't discuss them very often. So I hope you're having a really nice weekend, and I will talk to you in the next video.